45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Looks like I'm starting to get some folks coming in, so thank you guys so much. Welcome everybody this evening to our 2024 Q4 quarterly update for the mortgage fund. This is always a super exciting time for us to kind of gather around and recap on how the quarter performed and kind of what's new, what's ahead, and all things happening in the mortgage fund. So this is always a fun event for us, and definitely excited. So my name is Vince Tomich. I am a real estate advisor as well as a fund consultant here at Marshall Reddick. I've been with the company now for coming up on 6 years, and wear a lot of hats here. So I help folks invest in rental property. I help folks with our business development for property management, and I help raise capital for our mortgage fund. I think one of the most proudest things for myself is just practicing what I preach, getting involved in all of those aspects and just being a practitioner. So next, I want to introduce our most tenured employee at Marshall Reddick, Pat Prunty here, who's the director of private lending and creator of the mortgage fund.
Thanks, Vince. Thanks for joining as always. Just want to say a big, super thank you from both Vince and myself, from all of us here at Marshall Reddick. It's a pleasure to be of service. The mortgage fund is, something that we pour into day in and day out. It's a big support of our private lending program here at Marshall Reddick, which has been in existence nearly 15 years and has just been a huge success. But none of the success in the private lending program nor in the mortgage fund comes without the capital partners. And so oftentimes it doesn't get said enough. And I just wanted to thank everybody again for the contributions, for the trust. And we're just going to continue to do what we've been doing. It's business as usual, and we're just expecting all of the safe diversification and distributions and profits just to continue. And we've got a lot of good things in store. So I think 2025 is going to be a fabulous year. I know Vince and I have been talking about it, and the rest of us here on the team, and it's just going to be a great year with many good things and many blessings for all of us.
Yeah. Awesome, Pat. So just really quick, want to kind of touch on the agenda, what it's going to look like tonight. So of course, most of you that are on the call are probably familiar with the Marshall Reddick Fund. You're probably already an investor. So we are going to, for those of you that are newer though, we want to cover what is the Marshall Reddick Mortgage Fund. We're going to go over some hot topics, the fund basics. We'll go over the waterfall, so all the numbers involved, some important metrics, and then what's looking ahead for the fund. So that's a quick snapshot. And before we dive in, I always like to kind of bring it back for those that are newer, that this may be their first time hearing about the mortgage fund. Pat, I always like to kind of quickly, ask ourselves, what is the Marshall Reddick Mortgage Fund?
And it's always just keep it super simple because it can get very complicated. But the bottom line is this is a private debt fund, which is really important to understand. We don't own any real estate. We're not syndicating real estate. In some cases, we're the type of a fund that's lending to those syndications. So we take capital from accredited investors. A lot of those are just our standard Marshall Reddick clients that have been investing with us literally for decades, from back in the actual Marshall Reddick days when he was still here and doing tons of events like that. But you do need to be an accredited investor, and we're of course aggregating and taking that capital and lending it out through our private lending program to sophisticated and experienced real estate entrepreneurs and developers.
Yeah, so one key point to that too is it's first lien position only. So that is secured by non-owner occupied scenarios only as well. So we're not doing any primaries, any second homes. So that really keeps us in the investment space exclusively.
Yeah, and just to touch a little bit further there, it's residential only. That's just something that Marshall Reddick's always done. So you'll never find us lending against medical or office. We will lend against greater than 4 units. So that's a little niche that we fill, but we don't do a ton of that. And if we do, they'll be small multifamily, potentially no higher than 15 to 20 units. As I mentioned, you have to be an accredited investor, and you receive a quarterly earnings distribution. So our fund does distribute earnings, 100% of those earnings each quarter, and that distribution is based on 2 elements. First, a preferred rate of return, that is 6%, and then also a share of the profits. And we've got varying profit splits, which Vince is going to dive into, and those profit splits are based on capital account.
Yeah. And ultimately, our target net to the investor is 8% per year. We're going to go over some more details, and we've done many years where we've been able to outperform that, which has been great. But that is our target. That is what we set out to achieve, and we've been doing a really good job of keeping right on track there.
Yeah, it's important to understand that's a net to investor return, right? So all of our third-party operating expenses, whether that's tax and legal, or whether that's the management fee, loan servicing, you name it, right? So that's the target is a net to investor of 8%. And from my perspective, invested in a lot of different things over the 20+ years that I've worked for Marshall Reddick, is for the risk profile here, that's a fabulous return. And the bottom line, folks, is that this is an extremely conservative, low risk, quite diversified, as you're going to see, and extremely passive, right? So it's like literally you just collect a check at the end of every quarter, and you don't have to do anything other than read the memo, join Vince and I on the quarterly investor call, and so on. So if you're looking for cash flow, I don't find anything better than this. It's just collect a check once a quarter, unless you prefer, of course, to reinvest your earnings, something that both Vince and I do, and just use it as sort of a forced savings plan, taking advantage of the compounding.
Yeah, nice, Pat. Well, here's a nice just distribution history over the last 5 years. So starting all the way from 2020, you'll see the quarterly distributions, broken out per each year. Now, one thing I do want to point out here is this is assuming our 50-50 profit share split. In a couple slides, we're going to break down how you can bump that up actually a bit. But so this is pretty much, the standard 500,000 or below each quarterly distribution. So over the last 5 years, and you can see that consistency, right? Our goal to achieve that 8% per annum is that 2% quarterly distribution, and you'll see across the board here, pretty consistent all the way through.
Yeah, and of course, we're always looking to increase the yield to the capital partners. Don't think that that's not at the forefront of our mind, but really more from my perspective is finding that happy medium of the yield, but also the risk profile. Right. I think that there's a lot of opportunities that we passed on from a private lending perspective where we could get, 13, 14, 15% yields. Maybe you could charge more than the 2 points that we do standard. But it's really important that we lend to quality borrowers, borrowers who have experience and have done this before. And when we do that, right, those folks have options. Okay. Their resume precedes them, and they have so much private capital out there in the world today that they can borrow on, right? So we have some niches that we fill there, whether that's speed or whether that's customer service. Our pricing really is, I think, of course, which it translates into our yield, is a function of the low risk profile that this fund offers.
Nice.
Yeah, so people always want to know, what does that since inception return look like? And of course, as you saw, that each quarter is unique and individual, but the range of profits and distributions is very tight. But if you have been investing with us since day one, like myself and Vince, and you've been reinvesting those distributions, you would have earned an 8.54% return on investment. And something I'm, again, very proud of, and something that we're always trying to increase a little bit. And we found a way to do that with our increased profit split tiers that are based on capital account.
Yeah, so Great segue, Pat. So yeah, as we touched on earlier, that history breakdown was based on the 50-50 profit share split. So as you can see here, basically any capital account with $500,000 or less or $500,000 or less is going to have that 50-50 profit share split. So you'll see here in Q4 of 2024, that is a 2.04 distribution. If we were to have 500,000 up to just below 3 million, that profit share split would change to 60-40. And you'll see that reflects 2024 Q4 at 2.15. So you'll see that bump there. And then we also have a third tier, right, which goes to a 70-30. So that's for 3 million or greater. And you'll see that Q4 bumps to 2.26. And you can see, you know, when you annualize those increases, there can be quite a significance there. And then when you add on top of that, you know, the function of even reinvesting that capital, you really can start to grow that pretty quick.
Absolutely, yeah. I'm excited about that 70-30 profit split. It's certainly a goal of mine to get my capital account up to that 3 million number. And, you know, that's north of 9% per annum based on the Q4. And so we're headed towards that 10% number. Again, always trying to find unique ways to reward those capital partners with higher capital balances. But with that said, it's also important to understand that this in no way affects or penalizes those with capital accounts at 500,000 or less. And what happens here is that management is taking a lower split of the profit, right? Everybody gets the same preferred return. It just becomes a function of after we hit that hurdle, that annualized preferred return, how much is left over each quarter, and therefore how much is split between the capital partners and Marshall Reddick. And again, it varies. So we are taking, as the managing entity, a little bit less on the capital accounts that have those higher balances. And that's important, right? Because we don't want to penalize anybody, as we have a ton of folks that are under that, you know, $500,000 threshold, and we appreciate them just the same.
Yeah, and it's been really nice though to be able to roll this out, because as Pat mentioned, those that are seeking cash flow and, you know, looking at properties and all these various ways, for us to be able to offer these increased splits really help to bump that cash flow up for those folks.
Yeah. So north of 60 million total capital now, and that's as of January 1st. And we're just going to continue to do what we've been doing, business as usual, as we roll into 2025. Just important to always kind of touch base on, you know, for those folks that are new. I know we've got a lot of existing folks on the call. It's like, what is the return and how much capital do you have after, you know, describing what is Marshall Reddick Mortgage Fund?
Okay, guys, so we're going to go over just our hot topics for tonight. As everybody is aware, you know, the Los Angeles fires that were on the news for quite some time, and Pat will go into some detail, but we're safe to say that we're very much protected against that situation. We're going to kind of dive into our investor portal. I know that it's tax season, and those of you that are eager to get your K1s and tax forms out, we'll show you and give you a little more insight to that, and then how you can add capital. And we're going to talk a little bit about, you know, the waiting room or being admitted to the fund in that process.
Yeah, again, just super hot topics that me and the team are always dealing with, and we'd like to just get out in front and address them as a part of this call. So when it comes to the LA fires, I just feel tremendously. I live in Los Angeles County, and, you know, it's just catastrophic to see that. So, you know, hoping the best for everyone and in terms of recovery. But just to jump out, there's no exposure to Marshall Reddick Mortgage Fund and our private lending program to those fires. And I think one of the interesting things about that is that although we're located in California, our exposure to California real estate is very low. So I've got just a Google map that I prepared here on the screen, and you can see the Southern California locations of property, collateral property that we have loans against. So we just did have, you know, less than a handful in the Los Angeles area. None of those were affected by the fires. But just overall, to speak to the diversity of our fund, you know, again, many states And so outside of, obviously being thankful that we weren't affected by any of those fires, that it just goes to show that having collateral properties located across multiple states, right, multiple different borrowers, lots of different single family homes, the diversity that we're going to continue to talk through is something that we hold in high regard here as a risk mechanism. And I think that it's really helped us in our initial 5 years of existence. Another hot topic that I get all the time is kind of getting familiar with the online investor portal. Certainly we have that. It's like logging into your Vanguard or your Fidelity account, where you're able to do lots of self-service items and options that are available to you. So for example, folks always want to reach out. Not that I don't want to talk to you or respond to your email, I always do, but you can update your earnings reinvestment election. You're taking the earnings and you want to reinvest, you want to change that, great, no problem. You can tell us that inside the portal. And same for the opposite way. If you are reinvesting and you want to start taking them, like, no problem, there's an option for you to do that. You can also connect bank accounts. It's the safest way for us to transfer money. It's connecting bank to bank through this portal, and it's through a Plaid integration, which is a very highly regulated tech company. And that connection of the bank account is applicable for a couple of things. Not only if you're taking, or if you ever in the future desire to redeem or take any of your earnings, we'll be able to have that account and be able to transfer that to you. You can have more than one account if you'd like. You can have as many as you'd like. But it's also for transferring capital to us, which is something we're going to talk about. And we just have a lot of folks who, start with a minimum amount or a comfortable amount for their capital stack, and then want to continue to build their exposure to our fund over time as they get comfortable. So it's a two-way trigger, and so then we're not having to trade wire information or whatnot over email, and which is unsafe and just could compromise and put us at further risk. You can download, of course, your quarterly statements and fund financials. We produce the fund financials on a quarterly basis. That includes the profit and loss and the balance sheet. Those are available on our website for download, but also for you as capital partners. If you have an existing position or access to the portal, you'll be able to download those inside the portal as well. Keep in mind, folks are doing more on their phone than ever before. And so there is a mobile app. You can find it in the App Store for your smartphone, whether that's an Android or an iPhone. And you just got to search for Appfolio Investment Manager. You'll be able to find it, and then it's your same username and password as if you were to log into this URL that you see at the top of the screen. Also, something that's interesting in there, and we love referrals. I mean, most of the 60 million that we have in this fund today comes from friends, family, and colleagues, right? We do a good job for you, we're going to do a good job for them. So inside your portal up to the top right, and I've got a screen clip for this at the bottom of your slide here, there's that refer a friend button. When you click that, it's just going to open an email, and it's already got a pre-populated body of that email that directs them to our mortgage fund website, right, where they can see what the returns are, they can see the operating history, they can see a map that shows our entire portfolio and all those details that you're accustomed to looking to. But it's a really quick, concise, that within a matter of a click and maybe 5 to 10 seconds, you can drop in the email address for a friend, family, or coworker, and they can learn about our fund and what we would love the opportunity to do for them. So keep that in mind, because again, we just absolutely love referrals, and that's something that's just obviously very near and dear to the real estate industry.
Yeah, and Pat, just to touch on that, for any of you guys that have questions or want to work through this together, I can make myself available to help assist, whether it's a portal question or even a referral question. If you have a colleague or a friend that is interested, tap on our shoulder if we can assist on any of these fronts.
Mm-hmm. Yeah, diving just a bit further into the online portal, there are several tabs over to the right part of your screen here. You can see what those tabs or those buttons look like. And obviously, here we are in 2025, right? So 2024 tax documentation, it's on everybody's mind. Keep in mind that your K1s, they're a bit complicated in a partnership, okay? So we are fast at work reconciling and getting these all together. We've already touched base with the CPA, but understand that these will not be available for download any sooner than March 1st. The goal is March 1st, and we intend to hit that deadline. We will notify you via email through the portal when your K1 has been uploaded and is therefore available for you to download. Okay, so again, please be advised, these won't be available until at least March 1, 2025, and likely will be available on that date. As far as the documents tab, again, that's where you're going to find your quarterly statements. You will also find the fund financials, and every quarter I issue a written letter, and you guys all get, whoever has a fund position, you got that last Friday. We always issue those on the Friday of the third full week following quarter end. So that that letter that I issue that's got some tidbits in there is also a part of that document that includes your quarterly statements and the fund financials for you to be able to download forever, right? They're always there. They're there for all 20 quarters that we've had so far. Of course, transactions, right? So if you ever need to go back and you're communicating with your tax professional or your wife, like I often have to do, and say, actually, how much money do we have in that, honey? Well, you can, log in and you can check under your transactions tab. You'll be able to see your entire contribution history, which includes your reinvestments. If you're a reinvestor like me, those are logged as contributions. You'll also be able to see your distributions, which if you end up ever redeeming or taking any capital, the distribution history will include your redemptions as well. Okay, as we round this out, the My Profile tab is where you're going to find a lot of those important details that we spoke about. So you're going to be able to update your contact information, whether that's a new email address, a new mailing address. You can also add contacts. Like again, me, I'm going to reference my wife, right? She loves to, log in, see what's going on there. And so I'm able to add her, or I can add my CPA, or I can add any contact that will be able to view all of the details of my investment position. You can connect bank accounts, as I mentioned, and there again, it's a Plaid integration. So right inside the portal, you can safely connect bank accounts, as many as you'd like. And then of course you can, as I mentioned, update your reinvestment election. So again, I've got a couple of screen caps here that I took from that online portal where you can find the bank account section, and you can click that button at the top right there to add bank account, or you can click the edit button when it comes to reinvestments and change your reinvestment from yes to no or no to yes. Again, all of that inside the portal in the My Profile tab. Okay, as I mentioned, lots of folks continue to contribute additional capital. Vince does this, I do this. It's just, there's no better place, in my opinion, to aggregate capital. It's a really liquid investment. We certainly do have a 12-month minimum hold that we'll talk about when we get to the basics. But after that 12-month minimum hold, you can call for your capital whenever you'd like. And we have a fantastic liquidity policy. And as a short-term lender, we just have capital flowing through the accounts every single day. So getting capital back to you is not a problem. So with that in mind, again, it's a great place to aggregate dollars. But unfortunately today, and there's reasons for this, you can't self-service, meaning you can't log into the portal, you can't sign the subscription, and you can't send us the capital without necessarily talking to us. We do want to talk to you, and we do want to take in a measured amount of capital, right? It doesn't do us any good to raise additional capital that we can't deploy. Right, so that's something that we're looking at on a regular basis. So, of course, Vince, as one of our top fundraisers, speak to him. His contact information is going to be on again here shortly, and we're going to hear from him some more. But also, if you're unassigned, you can email our group fund email, which is mrmf@marshallreddick.com. And in either case, whether you go through Vince or through the group email, you will eventually, when you want to contribute more capital, you will sign a new subscription agreement, right? It's that one page. We'll do that via DocuSign, very simple. And then we will issue you a capital call, which will allow you to log into your portal, hopefully where you've already connected your bank account, and be able to press go to that dollar amount that you agreed and we agreed to accept from you. Okay, so it's that simple. And again, we have people doing that regularly. So I thought I would just come out and say, hey, here's how you do it in a public sitting.
Yeah.
Okay.
And Pat, just as a follow-up to that, a lot of folks who are first-time investors do start with, a position they feel comfortable with. And I can't tell you how often after, a quarter or 2 quarters, they decide to add. So we're trying to make that process as easy as possible. And as Pat mentioned, there's a lot of ways that folks use this, whether it's money that they want to be using on an ongoing basis, or I use it as an extremely high yielding savings account, right? To be able to really bump up and get those savings where I need it, whether it's for a larger purchase or whatever it may be.
Mm-hmm. Yeah, absolutely. And just also to mention on there, a lot of folks kind of like the set it and forget it mentality. That's something I have adopted, right? So I have automatic debits that I've set up with our accounting department, where they're debiting my bank account that I've connected to the portal on a regular basis, whether that's the 1st and the 15th of the month, or if you want to do it on the 15th and once a month, it doesn't matter if it's weekly, quarterly, monthly, whatever works for you. And in terms of the dollar amount, again, we welcome that as you get comfortable and build your exposure to our fund over time. Okay, so this is a big one, right? And this has been a big topic of discussion because we have had some increased wait times before being admitted to the fund. And so I just like to come out and talk about it. The bottom line is that each new contribution, each new investment that you make into our fund first is deposited into our subscription account. This is what I refer to as the waiting room. You are waiting for us to accept your capital and admit you to the fund. I don't wish to do it this way, but this is our ability to avoid yield dilution, depending on a number of factors that are happening. And trust me, folks, the chess match that I am playing every single day in terms of cash management is hectic. I enjoy it. I like approaching it every single day, but understand that I desire to admit your capital into the fund as fast as humanly possible, but not to the detriment of the existing capital partners who have come before you. Okay, that's really important, because once you're invested, you would appreciate it if I do the exact same thing. So historically, and since inception, the average wait has been 26 days. Okay, 26 days. Sometimes it goes up, sometimes it goes down. But there's no secret that in the last 2 quarters, Q3 and Q4 of 2024, we did have some increased wait times that were above this 26 days. Again, I don't want that to be the case. I desire to move your money as fast as possible, but I do not want to dilute the yield of the other capital partners who have come before you. Note before I move on here and dive into this topic just a little bit more, that your reinvestments are exempt. So if you're like me and Vince and you automatically reinvest your earnings every quarter, those are added to your capital account on the 1st of every quarter. Okay, so they are earning immediately, no downtime. But if you're putting in $1,000 a month or $5,000 a quarter or whatever it is, or even just lump sums, periodically 50,000 here, 100,000 here, those will always go through that first time from subscription to the operating account. Now, when you come in and we receive your funds, we will confirm receipt and deposit to subscription account. You get an automated email saying, hey, it's here, and cautioning you that the average time is X, and it could be more, it could be less, and pointing you to our paperwork where you can read about this policy. And then we will email you again to confirm acceptance and transfer of your funds to the operating account. Okay, so we will let you know. And again, there are many, many moving parts that affect this. And this is what the case was here in 2024 in the latter 2 quarters, where we had some heightened wait times. We had a large number of loans that paid off. This is something that I can't control. Okay, and I've started to realize that there's a trend. I think what it has to do with is that there's a spring selling season in real estate, and that kind of translates into contracts for real estate in the summer, and then those start to close around sometime in Q3. Okay, so that's great. We love the liquidity. We want to take those payoffs back in. And when I get those payoffs back in, I'm deploying them immediately into new loans, or I'm deploying them to construction draws. If you take a look at our balance sheet, folks, you'll see we've got $8 million in construction loans or construction draws on the books, right? I could get called for those at any point in time. And then, of course, we've got investor redemptions that pop up, and people are really aggressive. Oh my gosh, I need money. I need it tomorrow. Our liquidity policy is good, but you ask that you give us 90 days to do it. Ask for your capital as soon as you can, but we're able to return those funds. Okay, but again, the idea here is that there are a bunch of moving parts, and anytime I get money back from a loan paying off, which was the situation in Q3 and 4, I must deploy that money again, which is already earning returns, before I dip into the subscription account and bring on new folks. I don't think it's an issue. People always want to try and time the best way to get in. I would love to say to you and always be 100% right that the absolute best time to put dollars in the quarter are the last 3 days of every quarter. Or if you want to look at it on a monthly basis, the last 3 days. I don't know, there's something about the last few days. But what I can't control is that, if you put money in at that particular time, that I don't get called for, 25 payoffs and get stacked with $10 million that I've got to deploy before I can start dipping into that subscription account. But just understand, I am thinking about it. It is top of mind every single day. But that's again why we're always taking in a measured amount of capital, so that we don't have anyone that's upset or thinks that we're trying to penalize them by keeping their funds in the subscription account and not moving them to the operating.
In one note, Pat, is, Pat shed a lot of light on a very brief moment in a rather, for a lot of folks, a long investment, right? This is a very short window that we are talking about of potential downtime. And it's, as Pat touched on, for good measure. And I just wanted to point out to everybody that this is only one time upon entry. Once your funds are working, they will be working in perpetuity for as long as you remain in the fund. So we are talking about a brief window here, but we just wanted to be overly transparent as to the why.
Yeah, absolutely, because we're getting that question a ton, and it's a perfectly valid question.
Okay, so fund basics. So I know a lot of you guys that are already in the fund may be familiar with these terms, but I do want to touch on this for those of you that may not be as familiar, to dive into some of the fund basics here. So we do have a minimum investment that is $25,000. As Pat mentioned, any entry or any investment into the fund is subject to a 12-month minimum hold, right? And then your earnings, you have, they're going to be distributed quarterly, and you have a few options here. So you can take those distributions, or you can reinvest those distributions, right? So if you reinvest those distributions, like we mentioned, you can have that compound effect, which is an incredible resource that the fund offers. And then if you want to take those distributions, you're more than welcome to. You can contribute as much as you would like at any given time, but just note that each additional contribution is subject to that 12-month minimum hold. And the same with redeeming. Once you've hit that 12-month mark, feel free to either call or email. We always like to have it documented, so email is a very good method to go about this. And as Pat was touching on earlier, we do our best to get that redemption to you in a timely manner. We do have that 90-day window that gives us enough runway to be able to exercise those redemptions.
Yeah, again, it's our desire to get you the redemption back as soon as possible. We have no need to penalize or hold on to it. It becomes a mechanism of cash flow, because every time I take dollars out of the fund, guess what? That's dollars that I can't reinvest into new loans. And of course, when we make loans, what happens? We make money, right? We make 2 points right out of the gate on the loan origination fee, and we start to earn 9, 10, 11, 12% monthly paid by the borrower on that loan, right? So if I've got 6 loans that I've committed to that are going out over the next couple of weeks, and then I get hit for $1 million redemption. They're like desperate for it within that 2-week period. That would prohibit me potentially from making those loans that I've committed to. And that's obviously catastrophic, not only for goodwill and for our name when it comes to, the borrower, but also it could drastically affect the yield to those existing capital partners who have no need for that liquidity.
And Pat, one thing before we move on, that I missed here is, regardless of if you take the distribution or you reinvest, you are going to be subject to the same taxes, right? So there's no way to avoid that. Now, one thing to note is, if you are investing in a self-directed retirement account, which we allow, which is a huge benefit to the fund, then of course that is an exception, right? Those are tax deferred accounts. So for those of you that have access or that have self-directed accounts that are interested in utilizing that for the fund, feel free to give us a call and we'd be happy to help get that set up for you.
Yeah, we have a lot of self-directed IRA capital partners. So we're north of 300 capital partners now, and there's something 75 to 80 of them are self-directed, and just a great spot, especially with that reinvestment option and no downtime.
To continue on for the basics, as Pat mentioned, we are a California partnership. You will receiving your K1, and we covered the timeline on that. Make sure you get your tax, you talk with your tax professional just in regards to the breakdown of that. But those will be coming out by March 1st or roughly, right? And the other component of the fund is you must be an accredited investor to participate in the fund. So that is basically the only benchmark that we have really prior to entry.
Yeah, and the accredited investor thing it's not a big deal. I mean, I think it's actually a pretty cool thing. You can become an accredited investor, via income or net worth. A lot of our folks are entering via net worth, and it's kind of cool to go through that process and to put together kind of that net worth snapshot. Some people are just absolutely shocked at what they have when they add up all their bank accounts, retirement accounts, and 401ks, vehicle equity, rental property equity. I mean, there's so many different things that are considered assets that can get you to that 1 million, and it's not a big deal. And this is not a Marshall Reddick thing. This is a government term and something that we are required given the structure of our 506c private placement.
So who typically borrows from us, right? So there is a traditional list of folks that we're dealing with on an ongoing basis. Flippers are a very common borrower, right? Those are the folks that are buying houses, renovating those homes and selling them for profit. You're going to also have your home builders. So folks that are, whether it's building from dirt or tearing completely down and building. Then there's going to be folks like myself who have a self-directed retirement account and need a non-recourse loan. I purchased an investment property in my solo 401k. Therefore, I need a non-recourse loan. I'm a perfect example of a borrower of private money, right? And that's what, of course, the fund is comprised of. There's going to be many, many situations where private lending can come into place. And, there's a lot of folks, even that maybe investors that have 10 plus financed properties that just can't go back to a conventional lender. These are all reasons why one may use private lending. So this is just kind of a snapshot for those that are curious of who is taking on this capital.
Yeah, I had a conversation this past quarter with a capital partner, and they were kind of questioning me with the fact that many of our loans are to flippers, right, who are buying existing single family homes, fixing them up and selling that. And their kind of premise or thought was, isn't that kind of like played out? Isn't there not enough inventory for this? And something that came to mind here as a child of a baby boomer is that, my parents are in their 70s, right? And I've come to grips that they're not going to be with me forever. But the baby boomer generation is absolutely humongous and is holding an outrageous amount of real estate. And they are let's face it, everyone's going to pass at some point in time, and that real estate is going to change hands. And so most of those children, certainly not my family houses, I'm keeping them all, but a lot of those children are going to be looking to dispose of those homes as soon as possible to what? Get to cash quick. And who's sitting there waiting to write them a check? It's that flipper who's backed by Marshall Reddick or another private lending entity just like ours. So the moral of that story is that I think that there is just an unlimited amount of single family home inventory that's out there that's just waiting to be flipped. It may not be distressed, right? But it probably hasn't been updated in 30 or 40 or 50 years. Right, so it's time to get rid of that shag carpet and that Corian countertop and upgrade, and that's what that flipper does. And it's, I think it's such a unique and interesting thing to think about because we're perpetuating the inventory for the first-time home buyers that are out there. A lot of these flips that we're funding are being purchased by the up-and-coming generations, whether that's X, Y, Z, and those folks that are buying their first homes. They otherwise wouldn't have the opportunity to do so.
Where can you find more details? We have an awesome website that really goes into great detail on the mortgage fund. It's marshallreddick.com/MRMF. You'll be able to see the capital, the returns, the performance, all the paperwork involved, the holdings, all the financials that one would need. I really guide a lot of people to there, and this is one of my favorite components of the web page, and it just shows where all of our loans are spread across the country. Pat was sharing a story about a capital investor who was concerned about flips. And one thing that I'll say is a lot of times people are taking that logic and applying it to where they live. Well, this is a really good illustration of where we're doing business and how that flipping and how that business, how popular it is across the country. It may not be so popular in in Southern California or in small markets that we're focused in, but when you open up your horizon to across the country, you'll see there's quite a bit of opportunity.
Absolutely. All right, let's get into the numbers from Q4. So when it comes to the waterfall, right, this is just how investment returns are allocated among participants in a pooled investment. And Marshall Reddick Mortgage Fund is a pooled investment, right? We are taking capital. We've got north of 300 investors today, and that number continues to rise. We distribute 100% of the total net income that we produce on a quarterly basis. We just wipe it out and start back fresh at zero. We allocate it as follows, right? There's always an allocation to the loan loss reserve. And then, of course, our biggest hurdle that we've got to get through is that preferred return. And then after the preferred return, we're splitting whatever profits remain with the capital partner based on your capital account. On the left-hand side of your screen now, you can see our profit and loss statement, the same one that I emailed last Friday, the same one that's posted on that due diligence page that Vince just spoke about, and the same one that's available for download in your portal. Okay, the total net income north of 1.5 million, the first time we've been over 1.5 million. And as I mentioned, 2024 was a fabulous year. We distributed nearly $6 million in total earnings. Just thrilled about that number and can't wait until that number's 12 million, then 18 million, and so on. We're just going to stick to the basics. But when this is waterfalled across all of the capital partner positions, and remember, those are changing all the time. There's incoming capital, there's exiting or redeeming capital. Those people that are coming in or exiting, right, they earn only pro rata based on the number of days that they're in the quarter. So the waterfall is not an easy calculation, but 2.58% is that net profit number. So that 1.5 million over everyone's capital account based on their number of days in the fund represents 2.58%. Again, that is a net number, but before profit split. Okay, so you can see here that we've already deducted to get to that 1.5 million our management fee, which is the largest operating expense that we have. Taking that a step further, the preferred return out of that 1.5 represents 910,000. So it'd be cool to see that number get over $1 million and just in terms of preferred return in a single quarter. But that is 1.5%. Again, annualizing these at each stage gets you to that 6% per annum. After that, right, so of course, just the simple math, there's 611,000 that remains that is to be split. Again, if that was waterfalled across everyone's position, that would represent 1.08% after expenses. And then here is where then we are distributing either 50, 60, or 70% dependent on your capital account. This breaks down then, of course, for each, I've given the quarterly return, right? So they're 2.04, 2.148, or 2.256. Again, depending on your capital account. And then I like to give those annualized numbers. Note that each quarter is slightly different. So next quarter could be higher, could be slightly lower. But Vince and I talked about earlier on, and we showed you all 20 quarterly distributions that we've had since inception. We're not expecting it to go down. We're not expecting it to go significantly up, but it's going to stay above that 2% number. And then, you know, if you want to earn that higher return, and you got to increase your capital account. And one of my goals might not happen in 2025, but I'd like to get that $3 million position, both personally, but also I'd like to get that number up to about a 10% yield. That's just for this risk profile is just an unbeatable yield, in my opinion, and a great place, not for everybody, as everybody's capital stack's a little bit different, but there's a lot of people with a lot of money. And so that $3 million number is achievable for those folks, and we want to take care of those folks. Taking a shot at the balance sheet here, again, same that was produced and is available publicly to anybody that wants to take a look at it. I mentioned earlier and talked about those construction draws, right? And you can see here that shows as a negative number at the top, or excuse me, the very bottom there. It's called lender draws on hold. That is money that we're committed to that could be called for based on that flip or new construction home, where we're obviously not giving them all the capital up front. This is an excellent way that we are utilizing to drive that yield because we're earning interest on a lot of that money, even though we haven't departed with it yet, okay? I also like to speak to at this time with regard to the profit and loss in the balance sheet is the loan loss reserve, which in this case came out to just a hair under 60,000. I've got a typo on the screen, my apologies, it says Q3, that should say Q4. But this represents 3.73% of income, so it's a negligible dollar amount. Okay, but this is a non-tax deductible expense to the fund, and this is a reserve for expected credit losses. I hope I don't lose you in the language that I'm using, but this is something that is required for a third-party audit, and we are headed towards having audited financials. Okay, this is something that larger capital partners want. This is something that we're preparing to undertake. It's just a matter of time. Okay, so we're starting to implement all of those GAAP accounting principles that are required for a third-party audit. So this loan loss reserve accumulates on the balance sheet. You can see it again, looking to the balance sheet you see on the left. This is the third line item down. We've got an accumulated loss reserve of just under 350,000. Okay, and so this is a bucket of dollars that will be used to offset any potential future losses. We have had very, very few losses when it comes to loans that we make, but that is possible, right? So this is that fund that will be used to offset those losses in the future, and again, is a requirement when it comes to GAAP accounting principles and third-party audit. So rounding out that waterfall discussion is, you know, what would a capital account at 500,000 look like based on Q4? Okay, so this is our middle profit split tier, so 60-40 split with 60% going to the investor who's got 500,000 up to 3 million. And so you would have earned in this quarter almost 11,000, $10,740, which divide that over your 500,000, that's your 2.148 return. Annualize that number just by multiplying it by 4. Again, every quarter is slightly different, but have been in a really tight range here. You're looking at pretty much an 8.6% return. And this is not even considering the reinvestment. So if you're reinvesting and you're taking advantage of that compounding, right, that number would even increase. So again, trying to push for the 9% number for those that are in our middle profit split, and trying to push for that 10% number for those that are in our upper profit split tier.
Very soon.
Well, we'll see. We'll see, right? Without compromising safety. That is the key. All right, so a couple of important metrics to always not lose sight of. Diversification, we talked about that, and this is something that other capital partners, and in fact, my top capital partner in this fund has a $5 million position, okay? And this is something that he always brings to me because he invests in many other funds, including a lot of my competitors here in California who are highly levered in California, right? So where they might have 85% of their capital deployed against California real estate, right? And they've got a bunch of issues going on with those LA fires, unfortunately. So I hope the best for them, and I hope the best for that capital partner. But this is something that he always brings to me, is like, there's super value in your fund, Pat, because number one, you're spread out all over the country and you're not hyper focused in one geographic market. And as we all know, real estate's hyper localized, right? So things happen differently in different parts of the world, whether that's the West Coast, the East Coast, the Midwest, the South, you name it. It's even different based on state and a lot of those, legislation issues that are happening. Okay, so just got expanded on this a little bit this quarter to give you a count percentage and a capital percentage for our top states. And a lot of people are really shocked to see that California, by count, only represents 6% of our portfolio, and even further, that it only represents 13% of our portfolio in terms of the capital. Okay, so we're very cognizant of this, and we want to make sure that no single capital partner, no borrower or loan represents more than 10%. And in fact, I'm on a mission to march that down to a 5% number. Obviously, as capital increases, it's going to be important to continue that diversification. But I think as long as we maintain close or under 5%, I know it says 10 here, but the goal is to get under 5% in terms of capital partner, borrower, or loan as it relates to the entire portfolio. That way the boat can't be rocked when any one capital partner leaves, any one borrower gets into financial liquidity troubles, or any one loan goes sideways. Okay. The other item that this capital partner always likes to bring to my attention is the low loan amounts, right? So our average loan amount, again, under 300,000. And you can see here, and sort of like, I guess you call that a bell curve in terms of like loan amounts under 100 and then up over $1 million, and sort of like where that lies. So again, just to point out that, even if we have a number of defaults, like, it can't affect the portfolio at too great of a detail unless we have some type of catastrophic financial situation that occurred, which, trust me, again, as a 20-year veteran at Marshall Reddick, I lived through 2008. I haven't forgotten what that looks like or what is possible. I certainly don't see that on the horizon right now, but it's good to remember that your fund manager and the people at Marshall Reddick were here when that time existed and are aware of what is possible in real estate. All right, so I mentioned previously more than 300 capital partners, and we actually stayed static. First time that's happened, but we did have a good amount of redemptions in the fourth quarter. I'll talk about that shortly, but we're still north of 60 million. And something that we always love, Vince mentioned, is practice what we preach. So we've got 35 MR staff who've put in almost $6 million of our 60 million. So I really, really like to see that 10% number as a representative of what we internally have at risk in this fund that is earning the same as you. The portfolio continues to rise in terms of mortgage investments. And we love single family homes. We will lend against duplex, fourplex, and bigger than multifamily, but the focus of this fund is that single family home, the most easily tradable asset in the event we find ourselves in trouble with a problematic loan. And then of course, loan to value. And I was talking with Vince before we got started tonight, and I've seen this sort of trickle down. The goal's always been to keep it under 65%, which we have since inception, but it's now trickling down and potentially could get under 60% loan to value. So again, ton of borrower equity at risk, which is another hedge against overall market risk, right? Because we can afford for the real estate market to come down. We don't own any real estate. We have the loan secured against the real estate, and we have only 60% roughly lent against the value of that property, at least at loan origination. And as a short-term lender, hyper-focused on 12-month loan terms, how much could the market come down in 12 months? Okay, this is not a situation where we've got a load of 5, 10, 15, or 30-year loans that could be drastically affected, maybe not within 12 months, but maybe over 36 or 60 months. Something to think about as you look at our portfolio on an ongoing basis. All right, so we raised an additional 2.53. That's just new capital coming in within the fourth quarter. And as I mentioned, we did have our largest redemption quarter. So, you know, that's is what it is, folks. You know, after 5 years of being invested in the fund, sometimes folks need to get out, and our fund offers that liquidity, right? So don't be worried that you can't get your capital out. You can. And again, our liquidity policy, which is driven primarily by the fact that we are short-term lenders making 6 to 12-month loan terms. We have maturities happening every single day, and loans are paying us off every single day. With those incoming payoffs, right, I am either redeploying into new loans, I'm deploying into those construction draws that we're constantly being asked for, and then I am also redeeming capital investors who are in the queue to exit. One thing I always love seeing too here is that we still have more than 50% of our capital reinvesting their earnings. Okay, so of our total earnings of 1.5 million, more than half of that is staying in the fund and taking advantage of that compounding as they continue to grow their capital stack and their exposure to Marshall Reddick Mortgage Fund.
Okay, what's ahead? So, as Pat mentioned, what's ahead for the mortgage fund? Business as usual. Slow and steady raise to 100 million. That's always been our goal. That's something that we're going to continue to move towards. And I think it's just in the same old way we've been doing it over the last 5 years.
Yeah, and we're just, you know, we are always taking in new capital, but we're taking it in cautiously and in a very measured fashion. That caution doesn't have anything to do with the market. It's just I'm very close to all of my capital partners. Literally, I know all 300 that are in the fund, and I like it that way. Okay, I've got a relationship. Vince has a relationship with these folks. And so we want to make sure we can deploy that capital. We want to make sure that we can keep it working, and we don't want to be any bind at any point in time, right? So we'd rather just do it slow and steady and continue to just meet the targeted return on a quarterly basis and just keep issuing that 2% or better coupon that you've come to be accustomed to. Just a quick visual here, you know, to illustrate that capital raise since inception over our initial 20 quarters, you know, just the way we like it, just business as usual, right? The goal was to get to 100 million on this fund. Who knows what we'll do at that point in time, but we're going to just continue to do business in 2025 and into the foreseeable future. So I spoke to this in the letter that I issued on Friday, and to me, it comes down to discipline, not style shift, where you have capital at your disposal and folks approach you for loans that necessarily aren't exactly in your wheelhouse, and you're getting pressure from your capital partners who are sitting in the subscription account, and we're not going to do any of that, right? We are going to stay disciplined. That is something that is extremely important to me. Okay, we are going to keep our common sense approach to things. And what I mean by common sense is, am I okay owning that asset for the amount that I am lending against it? Because let's be honest, that's our worst case scenario as first lien lenders. We're going to take that property in a foreclosure if the borrower can't dispose of it and pay off the loan. Okay, so as long as I'm okay owning the property, which to me is like, hey, I'm a real estate investor too. Okay, and I love buying properties at discounts. So when I make loans, it's almost like, remember our LTV, 60%? It's like buying a property, God forbid they default, at 60% of market value. Could be worse. Okay, so again, it's common sense in that approach, right? And common sense, again, has many other things that factor into it. It goes into lot size and location and square footage and number of bathrooms and school district. I mean, all these different metrics that our underwriting team is looking at on a regular basis when we are making choices about what loans are going to be funded and which ones are going to be funded by Marshall Reddick Mortgage Fund. Because certainly our other loans and Marshall Reddick Mortgage Fund is taking the best of the best that's coming through our origination channels every single month. Okay, so we're going to keep doing the things that we've done for the last 5 years. And by the way, we're celebrating a 5-year anniversary, right? This March, can't believe it's been 5 years. Be on the lookout for an invitation. We're going to have some celebrations pretty soon. We'd love to share that time with you as our existing capital partners. Anyways, as we move along, right, stick with conservative underwriting, like I mentioned. We're going to keep that portfolio LTV under 65%. Diversification, we've spoken about, laser focus on short-term loans that allow us to get the capital back, keep and maintain a good liquidity policy. And when we have that capital back, just keep earning the 2-point loan origination fee and reprice our interest rates in the event of a volatile interest rate market. Okay, and then of course we're going to do all of that without compromising when it comes to borrower quality and experience.
Awesome, Pat. How do I get started? Those of you that are not in the fund, 5 steps to invest. You know, we'll go ahead and start by booking a consultation. Reach out to myself. Feel free, I will be doing follow-up calls after this presentation just to reach out, answer any questions that maybe we didn't get to, and help you get started. First step would be get accredited. We'll go ahead and handle that. There's various paths we can take to get that accomplished. Very straightforward and easy for that we can make for you. Get access to the fund portal. That'll be the system in which you are able to log and track all of the fund performance and connect bank accounts, etc. Sign the subscription agreement. We're going to go over how much, what type of investment you're going to have, how you want to take title, if you're going to take distributions or reinvest. We'll go over all those details, and it will be in the form of a subscription agreement. And then last is deposit your funds. So whether it's ACH, wire, however you decide, we'll be able to get those funds over to us and get those in the subscription and ultimately into the operating account.
Yeah, and all when it comes to the deposit of the investment capital, going back to the fund portal, the preferred method, I think both for us as the fund management team as well as the capital partners to do so inside the portal is the safest way to do it. It's the most cost-effective way to do it. There's no fees to you as the investor, and you've come accustomed to that type of technology with other firms in which you're investing. Okay. However, if it's a larger dollar amount or you prefer to mail us a check, no problem. We can still do that the old school way. If you prefer to send us a wire transfer direct from your bank or through your online banking, no problem. We can accommodate that too. And we'll be just as creative as possible without, being overly burdensome to the management team and especially our accounting team. So as we wind that down and we, again, give thanks and gratitude to our capital partners, I do just want to take an additional minute to thank Vince for joining me. I want to thank the rest of the Marshall Reddick team. That goes to not only our extended team, but our internal private lending team, and a big shout out to our accounting team, who oftentimes does not get the thanks that they deserve, who is working day in and day out. And I tell you folks, our accounting is tight and we know exactly what's going on all the time, and it's made our march towards having those audited financials as easy as possible. So thanks again to the accounting team and to the overall Marshall Reddick team for all the efforts. We appreciate you.
Yeah, thanks, Pat. This has been an awesome presentation. We look forward to connecting with all you guys over the next couple days, and we appreciate your time this evening.
Bye-bye.